I know. I'm switching locations to when I show the visual, it's going to be a nice place, I promise.
Right, it's so weird when you're on camera and you're the only one and you're just like staring at yourself.
I lo- I love it actually. I do this to vendors all the time when I have demos, and I love seeing them. One of my favorite little petty pleasures in business.
No, I hate it. Then I usually go off. But since we're doing this and we are live, then
It's true.
it's true.
It's
I'll stay on camera for everyone that's joining us this Friday for the last word. Pretty exciting. I can't wait to see the scenery where you are. My
so
scenery is not that exciting.
so what's funny is so my wife's family is from Detroit, and she has one sister, and amongst the five original siblings total, and it's her 40th birthday tomorrow. So three couples got away from our kids. We're at the Napa Valley Marriott. So let me tell you, like my wife and I never, ever, ever get away from our kids together. Like it's been over 3 years. So it's a nice thing. I mean, this worked out great. They just went to breakfast in the hotel. They're going to order me an omelet. When I'm done, I'm going to go there and scarf it down and go to my next call. And I've already had two calls this morning. So I'm a horrible example of work-life balance, everybody, because when you're off, you're a day off, there's no days off. So please don't do as I do, just do as I say.
Here's the thing I would say. We are so lucky to get to do what we do. The impact that we have on people's lives in the mortgage business and just what you get from financial stability, from having a home of your own, just even the feeling of being able to hang up your pictures and paint your wall and do those things in addition to creating generational wealth. Dude, I want to work on my vacation. I want to be able to have that kind of impact all the time.
Well,
So
you
that's
you
balance
said,
for me.
yeah, I mean, that's the thing. It's like it's not a job, when you love what you do. I mean, yeah, there's some grinding ass years like the last couple of years where, you feel like you're banging your head against the wall at times, but you're right. I mean, if you zoom out, I mean, I ended a call today. So, we do a marketing, IT, engineering development call every Friday just to see where all our initiatives are. And I ended the call today with, by the way, so the market was a wild ride this week, and it's stabilized, and rates went up a little bit from dipping down, and the stock market's back up after selling off, and people were freaking out, and so for now things are good unless you know there's another pandemic or Russia nukes Ukraine or Israel nukes Iran. But have a great weekend. It's like that's our business. You know, so it makes me really appreciate what we do for a living.
We did have a wild ride this week in particular. Let's talk about kind of the last 10 days. When you look at where interest rates are, it's like the Fed really, I feel, was delinquent in not cutting at their last meeting because 2 days later we get the print that we got, and it's like, yeah, maybe you should have seen that or felt
Yeah,
that coming.
it. I've always wondered when there's a Wednesday press conference and a Friday big report, whether inflation or jobs, right? I've always wondered if they get access to that information ahead of time. I've always assumed yes, but you would think that, and then I kind of go back and forth. Well, even if they did, they probably wanted to play like they didn't, right? And if they didn't, well, then they didn't. So then they can play ignorant either way, right? And so, yeah, I agree with you. I mean, that Friday, we were on here last Friday. And by the way, for those uh, wondering, Christy was going to be our guest either way, right? And then Brian unfortunately had a conflict, a business conflict this morning. If anyone's wondering where Brian is, we miss you, Brian. Love you. But yeah, we were talking last Friday about rates, and like, here it is, we're here. And then on Monday, the yen carry trade blew up. I was getting text messages on Sunday afternoon, like, oh my God, what's going to happen? They're about to have World War III, in the Middle East, and the yen carry trade's blowing up, and what's going to happen? I mean, people were texting me like, the end of the world was happening on Monday, and for as hectic and crazy as it was somewhat orderly. So but rates got better. We had a humongous lock date. I mean, for us, right? So I'll give it perspective. So we locked $1 billion in loans at PRMG last month. Okay. And on Monday, we locked 105 million and another 75 million on Tuesday. I think people were generally floating last Friday because they're like, okay, rates are just now starting to get better. And so we had a really big 2-day lock flow. I think we probably locked, the first 4 days of the week, 250 million. So a fourth of all of last month in just 4 days at a 22 business day month. It reminded me of February of 2020. We locked $1 billion in February of 2020. And then the first week of March, when the pandemic news was kind of starting to roil around the world and the bond market was reacting, we locked $1 billion in 5 business days the first week of March. So it made me kind of so it's not, just to put it in perspective, it wasn't as bad as that, right? But it was still, a little flash of locks.
But here's what I think that did. It's when you start to hear something's going to happen, and then it doesn't happen, right? We saw all this marketing when rates started going up about, date the rate, marry the house, go ahead and buy. And we've seen inventory increase. We have seen a decrease in buyers, right? They're sitting on the sidelines. So we're seeing higher instances of price cuts for homes. What about a third of all homes now are having price cuts? Could be more or less in your market, but nationally we're somewhere in that third range. You are starting to see more activity today because people had dropped off because they were like, yeah, the rates aren't going to go down. We're just going to have to wait. There's the craziness of the election. And I think this little blip got us to the point where people are going, okay, well, maybe it really is going to happen. Rates are going to go down. I'd better go ahead and buy this house before the sellers decide not to sell and they decide to wait. And I better do it so that when the rates come down, I can refinance. Like it feels like we have a lot of that. What it feels like, Kevin, is we have a lot of opportunity as originators to really be out in the marketplace, educating folks and driving contracts and closings, even ahead of the election.
I agree. And I'll say that the conversation is a little bit easier. I'm not saying it's easy. And there's more conversations, which makes the job a little bit easier, not easy for originators and realtors alike. When things like that happen in the market, there's still a lot of work to be done. There's still a lot of people are like, well, I'll just wait for the election to see what happens with rates. I'm like, that is the dumbest logic and reasoning I've ever heard. Literally, when I hear that, I'm like, oh my gosh. Now, what is maybe a little more intelligent, but still kind of ignorant, is when they say, I'm going to wait for the Fed to cut the rates. But that's someone who doesn't know that literally, I mean, in some programs, rates are 1 point better than they were since May.
Right.
And so, that's where an expert, what, my heart is having palpitations, but I'm going to wait. Okay. I think I'm okay. I'm going to wait.
Oh, Kevin, I think we lost you for a sec there. I don't know if you can still hear us, but I get what Kevin's saying. He's, if you're having heart palpitations, you can't wait to go to the ER. That heart attack will kill you.
100%. So I'm moving to somewhere nice where you can see me.
Okay, I like it.
Yes.
Kevin really is probably at the spa. Kevin, I'm just wondering if you're going to have a cocktail in your hand. I know it's only like 10 o'clock in the morning, but
I know we should totally have a cocktail in our hand. So this is such a cute little place. This is the garden.
Well, we can't see the garden. I see the lovely, you have the same background I do right this minute.
No, I'll handle that in 2 seconds. I apologize for that.
We do at least know you're dressed and you're not hanging out and, with the bed sheets up.
Oh yeah, I'm dressed. We're good. Okay, no background. Okay. Sorry. I love the last word background, by the way. By the way, I know we waited 10 minutes for my background. This is not as good as Rob Chrisman when he was driving and pulled over in Memphis to do a podcast together. and there was a cemetery in the background. That is still my all-time favorite background. He is an absolute legend. There's like Connect Four here. There's Jenga. Don't worry, I won't be a jerk and knock it down. We got ping pong, cornhole. It's like a cute little garden here, this little Marriott. So I'm just gonna sit my little happy butt down on one of these tables and continue on with you.
And enjoy the good weather. Well, as we talk about your happy fanny, what are, one of the things so yes, Chris, you're exactly right. If everybody waits for rates to drop, more folks are going to be vying for those same very limited homes, and it's going to push those prices back up. Speaking of prices, as we see rates go down and we're in this lower rate and more volatile environment, that really has an impact on the finances of mortgage companies. And lower rates mean lower MSR values. They mean early payments and, having to give back some of the profitability. And that, depending on you as an originator, that may impact your income, because your compensation agreement with your company may say if there's an EPO, they get to take back some of that commission. Kevin, what are you thinking about these days with that?
It's funny you bring that up, because I did a video last Monday heading into the Fed meeting, and I talked about lower rates hurt servicers on their book. So you bring up a very excellent point. Like we buy and sell money. The transaction is not over in the industry when the originator gets paid or the lender gets paid at funding. So then that mortgage servicing right, that MSR, makes its way to the secondary market. Who knows where it ultimately lands? But those servicers fully intend to keep that loan a certain amount of time. They hope for life, and they think that's their asset. Whereas the originator is like, well, that's my relationship. And so some servicers are like, well, I bought that relationship. Well, you bought a servicing relationship, but you didn't originate. And so there's always some conflict there in our business, and there always will be. It's never going to go away. Like, unless the servicer is also the originator, they can't really lay claim to that. And even still, they're under attack all the time from competition. We all are. So yeah, there's a lot of chatter about early payoffs, EPOs. There's a lot of, I just was reading a Facebook group just now, and someone said that a really large lender, right after the sixth payment, the lender retention team, the servicer, who is also the wholesale lender and the servicer, their retention team called that originator's borrower, and they were pissed. And they're like, I'm never selling them a loan ever again, And then everyone's like, well, make sure. Are you sure? Maybe it was someone acting like the lender, and they start going through all these different things. So, wow, get ready for all these little battles. But ultimately, whether you're a servicer marking down your portfolio, your originator fighting against the servicer, the overwhelming trend is that we're all doing more business. So there's just a lot more business out there, and, with lower rates, homes are more affordable, and more borrowers are out hunting. And we all make up for it with just more upfront origination, regardless of the battles that get fought for loans that are currently being serviced.
Yeah, it's interesting to talk about the battle for the loans that are being serviced, because you're right. It's not just the originator and the servicer who are doing that. We've seen a hope for some reprieve around what happens when you pull the credit report and that lead being sold and 100 people calling. And for those of you that are on the call, you probably know that we hear people outside the industry and they're like, it's a lie. It's not 100 people. Dude, I've seen it be upwards of 300 folks, that 300 calls go to a borrower when they pull credit and that lead gets sold and gets sold and gets sold and gets sold, and everyone reaches out. So we are under attack from that standpoint. We continue to see pressures against margins, to your point, on the MSRs, and that has an impact on what everything is worth. In addition, if a servicer that's trying to buy that MSR doesn't believe that it's going to stay on their books for a long time, they value it a lot less. And that servicing release premium, that MSR value, is what gets passed on into lower rates. And so that has an impact on where we see the market, no matter what's happening, which also leads to kind of the next thing we wanted to talk about today was, with where a lot of companies are, we are in our 8th, maybe 9th quarter of losses. And so we're really starting to see some big M&A deals in the marketplace. There's been a lot of M&A deals that were much smaller, much quieter, but there's been a tremendous amount of M&A activity this year. The three kind of big ones that happened this week, or in the last couple of weeks, Planet Home Lending is going to acquire the retail division of Axia Home Loans. Mr. Cooper is going to acquire Flagstar Servicing and their TPO business. OceanFirst Bank is going to acquire Garden State Home Loans. And I can think of, 5 or 6 more that are much smaller that didn't make kind of the same splash. What are your thoughts on that, Kevin? What do you think that the folks on this call should really take away from that?
Yeah, I think each one's different. So, for example, the OceanFirst Bank and Garden State's is a great company. It's got consumer direct roots. It's been around a long time, and obviously, getting connected to a bank, you're going to get lower cost of funds. So, when you're more call center type business and you have consumer direct, you need rates. It's kind of like your edge. Axia was, floundering, very small, terrible leadership. They just needed a bailout. They were just getting blown out. Big group left them to Mason Mac. Their wholesale team wasn't doing much. So that was just more of like, help me out, failed leadership type deal. Now the Mr. Cooper one is really big, right? So I don't want to use the word failure with Flagstar because obviously you worked there, but like it went from private to bank to bigger bank, and then the New York bank had issues that they needed to be bailed out, which are way bigger than our business. With their commercial real estate side, former Treasury Secretary Mnuchin came in and helped put together a $10 billion fund, $10.1 billion fund to bail out a New York Community Bank after they had acquired Flagstar. And so I maybe you would know better the metrics of the deal, but the CEO of Mr. Cooper, Jay Bray, was at the Core Connect, and he was actually there present like the day after this thing was announced last Monday, and he was receiving the second annual Frank Notaft Award. He was the chief economist of CoreLogic that passed about a year and a half ago, and Jay was there, and so, and despite all this crazy, big, humongous, noteworthy M&A, his team just gobbled up, Flagstar and their TPO teams. They were acquiring it, and so typically, when you see big M&A, it's really about the servicing book. I mean, this is like every owner's struggle in mortgage banking. When it's like end of life. Like for me, I'm 47. I'll be 48 next week. Like we're not going anywhere. Our CEO, our founders, they're young. Like we're all in right now, so we don't really want to go anywhere. But when you get to the end of life and you're like, this is my baby, my company, I built this whole thing up. God, it's worth, so much to me. And then you go to sell it and they're like, how much is your servicing portfolio? Okay, here's what you're worth. And that's it. I mean, it's like 2x EBITDA with a 3-year earnout if you stay on, where you sell for 1.1 net tangible book value. Now, book doesn't mean the portfolio. Book value is an accounting term. That is all we're worth, sadly.
No, but it's interesting that you talk about that. It relates back to homes. How many times have you seen a home listed that because the seller lived there, they thought it was worth more? And you hear agents talk about that all the time with having to negotiate with sellers about where the home should really be listed. So I kind of look at the number we talked about at the beginning of the call with the number of price cuts. I think sometimes that's over exuberant sellers thinking the market is still going to continue to rise and they're going to be able to take advantage of that, as opposed to the house was, the values going down, right? We continue to see home values increase. But when you look at M&A, absolutely, the business is worth a lot to somebody that built it, that has their blood, sweat, and tears in it. But the valuation today is not the same as it has been in the past. The loyalty to that book of business is a little bit different. And so you are seeing it look very, very different. When the publicly known information about the Flagstar Mr. Cooper, to your point, it's really a small multiple above the value of the servicing book.
Yeah, it's usually just a small little number. Like, Franklin American, great company, Ray Crockett and team. We have a wholesale correspondent channel, so we know all these great AEs that are over there, and they were a force to be reckoned with. even in your state, Texas, for many, many years. Although I believe they're out of Tennessee, Franklin, Tennessee, 1.1 net tangible book value, like here's your portfolio, you have your portfolio is worth $500 million, your book is worth $500 million, here's 550, sail into the sunset, which, and so, the metrics on these deals, like I say this all the time, and please start using it, but like we are family and we love each other and we have this culture. And by the way, I love what you guys are doing at UFCU. Like I'm seeing all the, all the, like the way, like the image is changing and some of the marketing and the vibe. It's really cool, and it's great. It's fun while we're here. Whenever companies sell, you realize that the secondary market is cold, heartless, and unforgiving. I don't care about any of that shit. Like, we are family. I love you guys. It's great. Okay, here's how much you're worth. That's it. That's our business. So it's almost like when you're a founder or an owner, it's like, why hang it up? You got this machine that's got return on equity. You're making money. You're doing cash flow. Yeah, you had some tough times. Yeah, it's tough. But once you give it all away, what are you going to do? Go play golf? Go fishing? It sounds boring.
And at some point, that's true. At some point, you're going to want to, you talked about that work-life balance. At some point, you may not want to come into the office every single day, or you may be forced to not do it for health reasons, or maybe you've made some, some financial choices that don't let you there. There's the gamut that's out there. But
Yeah.
we are, you have a young group of leadership. The team that I have is a young group here. So our senior leadership, our C-suite we're all of similar age. So I think we're pretty young, by the way, Kevin. And right,
I was just with my sister-in-law's friends who I hadn't seen in a long time, and they're like, "You don't look anywhere close to 40. You look a lot closer to 50." I was like, "Yeah, I'm almost 48 next week. So thanks a lot, dude."
it's there. I mean, I turned 50 this year, right? I'm actually pretty proud of that. Like my 50th birthday was earlier this year. I still think we're pretty young because there are a lot of folks but this is an aging industry, and I think we're going to see some additional M&A as people figure out they don't want to continue to work in the business, that they do want to go swing a golf club or take some vacations, and they may or may not have the succession planning that, with either a family member that wants to take over the business or somebody that's in the business that they believe they can sell to, and there's opportunity. So I think we're going to see continued consolidation as people approach retirement age. Now, maybe some of this rate drop will give people some excitement to come on there. By the way,
Good.
JA, I appreciate that. We're puppies.
Yeah, I'll take it. I don't know. You look better than I do for your age, but I need to dye my hair.
I don't dye my hair. This is the natural look. So we have a couple questions in the chat around, how does Planet purchase an ESOP? Axia is an ESOP. So how do they do that? What are the mechanics of that? And what does it look? What about the trend of credit unions buying banks? So where do you want to kind of go first? We got 6 minutes left and a few more comments in the chat.
Yeah, I mean, the interesting thing about an ESOP is it's a great hook and people like to talk about it. But if your company doesn't make money, then your shares aren't worth shit, right? So I think that all would depend on the price paid for the assets that were purchased by Planet Home. And they're not dummies at Planet Home. They are a great group and a smart servicing group. Trust me, they got the better end of that deal. So anyway, and as far as credit unions and banks, that's interesting because credit unions and banks have so many different revenue streams other than just mortgage, right? So it really, there's so like the example that we talked about with New York Community Bank selling the Flagstar unit to Mr. Cooper. New York Community Bank is trying to find ways to where their balance sheet can get shored up and a regulator will say, you guys are in a good spot. And so sometimes you sell something that's valuable, like your mortgage servicing portfolio, and the team tagged along with it. And so anyway, that every bank and credit union is different. Like I you're in your strategy meetings over there. I don't know what you guys talk about, but you have to worry about deposits and your members and car loans and what's the runoff on the credit card? Are they delinquent? Like, There's so many things that banks and credit unions deal with that I don't envy whatsoever.
Well, it's interesting, and I'm going to approach the question of credit unions buying banks a little bit differently, and just talk about go back to this whole M&A consolidation. Why do people do M&A? And we saw two very large regional players, merge. They have a purple logo. You might want to, and one of the things that they talked about with that merger was the tech cost and being able to compete with some of the larger entities. And those guys are significantly larger than a lot of these credit unions and banks. And so you think about the same thing being true with an IMB competing against, UWM and Rocket and the money that they put into technology. So sometimes those costs and that economy of scale may be what's driving these conversations. Obviously, don't have insight into every single merger deal or thing that's happening, but you do hear that kind of conversation in the industry. I hear it both, in the IMB space, I hear it in the community bank and the credit union space. And so I think we'll continue to see some consolidations as it's harder to survive as a medium-sized person. I think as a super tiny group, you can leverage some things in a different way. You get to a certain size, you got to get to a bigger size in order to be able to compete. So I do think we're going to continue to see some of that stuff.
Yeah, I agree. I mean, you look at the ICE and Black Knight acquisition, right? Like, they got big fish eat little fish, right? Like, it's a huge acquisition. And you look at like the tech side of it and the data play side of it. Maybe analogy would be like, I mean, how many cell phones on there? Pretty much everyone I know is on an iPhone. I'm on an Android. And then after that, it's like, you have a Google phone and a Windows phone, or an LG phone, but they're really like a lot of, I mean, behind the iPhone and the Samsung, like regulars seem to not really be worried about having just a few big winners. And so, I'll just say that, in our business, you brought up Rocket and UWM, they enable originators at the local level to go out and be brokers. And that actually kind of makes it like a little more fractured. And so you see some of the trade organizations like AIM and NAM and Broker Action Coalition try and kind of bring those kind of one-off companies kind of back together, which I think is a good thing. Trade organizations are very powerful and kind of bring in what would normally, like if you had a bunch of travel agents everywhere, like how do they protect their job from disruption? Because so you look at you look at like this, there's a little uptick in market share in the broker channel, right? And so you look at that rise and you go, well, that's ripe for disruption now, because a marketplace could come in and get in front of the consumer. And I think we're seeing that right now to kind of bring this conversation full circle. Servicers in our business have made a bet. They're going to win this time around. So as originators, we have wholesale, correspondent, and a retail channel. We service a little bit, but servicers have made a very big bet that their technology and their retention and their game and their teams are going to get in front of consumers and offer a better value proposition. And now for realtors, you got the NAR settlement that's going live next week or next weekend. And, so now their commission is under attack. Same as it ever was. We're always under attack. But the bottom line is like the more fractured industries get, the more it's ripe for disruption. I mean, look at the rise of wholesale and UWM. They came in, Matt Ishby and team, they're brilliant. They saw this void of leadership and this void in this space. And honestly, Dodd-Frank really gave them a huge leg up. You cannot put your comp as a broker over 275 gross to run your whole business. So the government said, if you're going to be a broker, you automatically are going out with a pretty good price. And so then you get a company, like our wholesale channel or UWM, you got, some other ones that are out there. You got some failed ones from the last run, but they come in and they enable these better priced, 1 person, 3 person, 5 person shops to go out in the market and compete. There's a little rise of that, but then that creates more opportunity for the servicers or for a consumer direct play, especially if it's tech driven or more data driven tech play. So I've only been in the business in so one, but I just constantly see new leaders all the time, new disruptors, So we're a 3-channel lender. We try and stay nimble and just kind of go with the flow. We don't need to be number one. We just want to keep going and have a nice steady growth. And, we have our value prop, and we just keep rocking and rolling.
KP, it's not a bad strategy. And I one last comment I'll bring up as we wrap this up. Scott put in the comments, hey, Mr. Cooper said in their last earnings call, their recapture rate was 73%, right? I think that number has definitely like lit folks on fire. I can remember times when I would hear recapture rates in 7, 8, 14%, people were excited when they would get to, high double digits, low 20s. 73% is phenomenal. And if servicers can do that, that could be a significant disruption for every originator, not just, brokers. So we
Yep.
have a lot of different models. Kevin, I know your goal, my goal, most of the folks on this call, everybody that I know in the industry, our goal is really to serve and to bring value to the people that we do business with. So we want to continue to do that. I think that's a great way to wrap up this show today, just talking about that remembrance of why we do this and the value that we get to deliver each and every time we have an interaction.
Amen. Well said. Drop last word right there. Chrissy gets the last word. Have a great weekend. Going straight to breakfast.
Everybody.